G'day guys, welcome back to the Devon Too Good Investing channel. In this video, we're going to be going over Dropbox's third quarter financial results. We're going to be talking about how the company is performing. We're going to talk about some of the struggles they might run into. And I'm also going to provide a valuation on the company so we can have an idea on what kind of return we might expect moving forward. So guys, let's not mess around. Let's get right into these third quarter financial results. So revenue, it came in at $591 million. That is an increase of 7.4% year over year. And on a constant currency basis, that would be 9.7 year over year growth. And of course, the US dollar has been incredibly strong this year. And when we're comparing to last year, there's obviously the US dollar's appreciated against other fiat currencies, and since Dropbox get revenues outside of the US, that obviously is a headwind, and obviously that's why if we account for revenue growth on a constant currency basis, that is why it is higher than the actual revenue. But moving forward, as once the US dollar sort of calms down and the trend reverses, this will then become a tailwind for Dropbox's revenue, in future years. If we have a look at their ARR, this is their annual recurring revenue. It increased 9.6% year over year, and on a constant currency basis, it would have been 10.2%. And if we now move on to some of the key metrics at Dropbox, there are two sort of key metrics outside of the normal sort of, your revenue, your earnings, your cash flow. The first one's paying users, and they ended the quarter with 17.55 million paid users compared to 16.49 million users for the same period last year. And compared to Q2, this was an increase of 180,000 paying users. Now, the second key metric is their average revenue per paying user, and it increased slightly year over year to $134.31 compared to $133.79. And you might ask, it hasn't grown that much, and there is a fairly logical reason for this. So Dropbox have introduced Teams plans where you can have 6 seats. So the Teams plans, you can have up to 6 seats. And as a result, these plans, they're more expensive, but it works out, the average revenue per user, because there's 6 seats, it pulls it down. But at the end of the day, it's still a net positive for the company. It's increasing ARR. You can see solid numbers in terms of that, and also it increases those paying users. So honestly, it's not much of a concern. It's fairly reasonable, and at the end of the day, it's still increased. GAAP gross margin, it was 81.4% compared to 79.6%, and then the non-GAAP gross margin was 82.9% compared to 81% last year. And this non-GAAP gross margin is already sitting within their long-term 2024 guidance. So that gets a check mark there. We're just going to be looking for this over the next quarters and next couple of years just to stay around this level. In terms of GAAP operating margin, it was 15.1% compared to 14% for the same period last year. And if we look at it on a non-GAAP basis, they had operating margins of 31.6% compared to 29.3% for the same period last year. And this is also within their long-term guidance range. So, around that 32% mark for non-GAAP operating margins is where the company is aiming in 2024. So just a slight improvement needed there. I'm sure they will get there. They have plenty of time to do so. GAAP net income, it was $83.2 million compared to $75.6 million in the same period last year. and non-GAAP net income was 153.1 million compared to 147.1. And you might ask, there's a difference here between the GAAP and the non-GAAP. Why is there this difference? And the main reason is because of GAAP net income accounts for stock-based compensation, whereas non-GAAP net income does not count stock-based compensation. As a result, you end up with a higher number. And obviously, stock-based compensation it's a non-cash expense, but to the shareholder, it's a real expense because you get diluted as a result. Moving on, free cash flow, it was 145.2 million compared to 22.5 million last year. Decent growth, looks relatively in line with earnings growth, and of course, earnings per share. The GAAP earnings per share came in at 0.23 cents compared to 0.19 cents. And then obviously, because of the stock-based compensation, the non-GAAP came in higher at 43 cents compared to 37 cents last year, and the company still has a ton of liquidity on the balance sheet. They've got cash equivalents and short-term investments of 1.43 billion. Now, scrolling down, there is just one more thing I want to highlight here. So we're going to move to the income statement. Just give me 1 second. Here it is. So we can have a look here at the weighted average shares used in computing the net income per share, or the EPS. In Q3 of 2021, they had diluted shares outstanding of 398.1 million shares. And as a result of fairly aggressive share buybacks, they have got the share count down to 360.1 million. So that's what we like to see. One of the big criticisms of this company is that, they dilute the shareholders because of their share-based compensation. But this company, their profitability is far outweighing the impact of stock-based compensation. And over time, the impact of stock-based compensation is getting less as the free cash flows continue to grow. And as a result, they're going to be able to have more money to place towards share buybacks. And obviously, it still has an effect because, as they're buying shares and reducing the share count, at the same time, that share count is going to have some upward pressure because of the stock-based compensation. But you can see it is trending down, and it's trending down fairly quickly. So, look, it's a fair argument. It has an impact, but it's not, by any means hugely affecting the company. If we now look at Dropbox's financial supplement that they've released, it provides us with updated guidance for 2022. And Dropbox have raised guidance pretty much across the board for fiscal year 2022. They've raised their revenue guidance. They've raised their constant currency revenue guidance. And apparently due to the strength of the US dollar, there has been a 300 basis point headwind for revenue growth, which is factored into these numbers here, which will provide a tailwind moving forward when sort of the US dollar normalizes against other currencies. They raised their guidance for non-GAAP gross margin. They also raised their guidance for non-GAAP operating margin, and they also rose the midpoint of their guidance for free cash flow. So obviously the business is performing better than what Dropbox expected. Dropbox did actually implement a price hike on some of their products, and one thing to think about moving forward is that because most of Dropbox users are on monthly plans, the price hike rolled over to most of Dropbox's customers in the third quarter, so that kind of explains why there was a fairly large jump in ARR. So don't expect that moving forward. Don't expect that 10% ARR growth. Probably expect something closer to 7% growth moving forward. But really here, it was business as usual for Dropbox. Despite the tough macro environment that most companies are sort of quoting at the moment, Dropbox is still performing just as usual. Shows that the product is sticky. It shows that it's a needs-based product. Obviously, Dropbox is mostly used by business owners, small business owners, creators. So these people need Dropbox essentially, and they haven't been getting rid of it, and the product's still growing. So really good quarter. We'll come back, have a look at it again in the fourth quarter. But before you guys leave, let's have a look at valuation real quick. So this here is a very simple valuation. So essentially, I've entered in 2024 free cash flow of $1 billion. This is what the company is guiding. And in their earnings transcripts, they pretty much said that it's a tough macroeconomic environment at the moment. They are facing currency headwinds, which is ultimately affecting their revenue, and which obviously also flows down to their free cash flow. However, they say it's too early to make any adjustments here. I'm still fairly confident that even if they don't hit this number, that they'll be fairly close to this number. I do think they will hit it though. Shares outstanding, I've entered 350 million. I think their shares outstanding will be about this number in 2024. I think this is fairly conservative. They are buying back shares quite aggressively, and if the share price sort of stays down, I'm pretty sure that they'll well surmount this estimation. In terms of the free cash flow multiple, look, Dropbox is a stable business, a recurring revenue business, high margin, and it's growing it's not growing quickly, but it's growing steadily. I think it's very reasonable that this business trades at a free cash flow multiple of 15. Even 20 wouldn't be too crazy, but for this valuation, let's put 15. These factors give us a share price target at the end of 2024 of $42.86, which gives us a CAGR of 28%. So that's sort of what we're looking at here. You don't have to agree with these numbers. You can easily do this yourself. It's a very basic valuation model here. Very few factors. It's just free cash flow, shares outstanding, and your multiple. I don't think I'm being too aggressive with any of these. I think this is a fairly likely outcome, unless something happens and free cash flow goes down the drain, or they stop buying back shares. Sure that these outside cases can happen, but to me this is a fairly likely outcome. But anyway, guys, thanks for watching the video. Glad to be back. Let's keep pumping them out. Have a good one.